Hey everyone, welcome back to Corporate Decoder. Today we are going to dissect a shareholder report about a mortgage portfolio. Fund something about how they plan to become a totally different fund. Before we dive in, if you like getting clear insights from these financial documents, subscribe. We also have a Discord community linked in the description if you want to discuss with other nerds. Fasten your seatbelts, we're about to uncover whether this fund is riding high on the housing market or if it is swimming against the waves. This is the annual report for the BlackRock US mortgage portfolio, running from May of last year to April of this year. Let's see how they did. First things first, how expensive is this fund to own? If you had $10,000 invested in their institutional shares, it would cost you about $47 a year, or roughly 0.45%. So how did the fund perform? The institutional shares returned a healthy 10.22%. That's compared to the Bloomberg US Aggregate Bond Index, which returned 8.79%. What helped them achieve that 10%? Apparently, betting on non-agency residential mortgage-backed securities, which simply put are mortgages that aren't backed by big government agencies. Commercial mortgage-backed securities, or in simpler terms, bonds backed by commercial property mortgages, also helped. What dragged down their performance? Not having enough of their money in those government agency-backed mortgages and some interest rates related missteps. Now let us take an overview. Imagine you invested $10,000 in their institutional shares around May 2015 and fast forward to April this year, 2025. It would be worth roughly $12,382. The Bloomberg US Aggregate Bond Index would have turned $20. Aggregate Bond Index would have turned $10,000 into 11,000 fast. And then $20 Aggregate Bond Index would have turned $1 Bloomberg US Mortgage Backed. Securities Index would have resulted in 11,190 tween. Let's break down those average annual total returns over different periods. For institutional shares, we're looking at an average of 10.22% over the last 10 years, which is not that good if you compare that to the Bloomberg, 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 you compare that to the Bloomberg US Aggregate Bond Index. It's 8.76% with a 1.34% over 10. The Bloomberg US Mortgage-Backed Securities Index shows a 8.99% return for the year, but is also negative for the past 5 years at negative 0.76% with a long 0.3T. Compare that to the Bloomberg. If you compare that to the Bloomberg, you compare that to the Bloomberg, you put over 10 years. The fund's net assets are almost $397 million. They are spread across 904 portfolio holdings. To manage all this, the investment advisory fees came out to just over $1.5 million with a portfolio turnover 25%. This means, simply put, the fund is very active in trading 5%. This means, simply put, the fund is very active in trading 5%. This means, simply put, the fund is very active in trading 5%. Let's see where that money landed. Almost half of it around to non-agency mortgage-backed securities. About 30% is in US government-sponsored agency securities and around 22% in asset-backed securities. If you break it down by credit rating, a bit more than a third of the investments have the highest ratings. Now for some big news, the fund is planning some major changes. They are going to change their name to BlackRock's Securitized Income Fund around August, and they are tweaking their investment strategies. By early next year, 2026, they want to turn the fund into an exchange-traded fund or ETF under the name iShares Securitized Income Active ETF. And finally, the audit seems okay with no disagreement mentioned, so everything is in order. Okay, let's talk about my assessment. BlackRock US mortgage portfolio did okay with that 10.22% return, and they seem to be making solid portfolio moves by focusing on non-agency and commercial-backed securities. Still, there is an interest rate risk, which is significant with low interest rates like they are now. Overall, its portfolio seems fine, albeit with high turnover. The proposed shift to BlackRock Securitized Income Fund could give it more flexibility. The plan to reorganize as an shares ETF opens more opportunity, which can be great. Keep in mind, past performance is not an indicator. While it may seem ready to handle market changes as they come, all things must be carefully considered. So what do you think about this potential transformation? Head down to the comments to voice your opinion, and make sure to support me by hitting that like button, subscribe for more, and join the Discord. Thanks for watching.